And I want to start by speaking about the challenges in the supply chain. During the pandemic, Merck had to respond to big surge in demand for lab equipment, and now that COVID lockdown measures in China and the war in Ukraine has disrupted the supply chain. So what changes did you make to the organization to deal with these volatilities?
Once again, thank you for having me, Ludwig, and thank you to all of you who are joining us virtually today. You may know that earlier this month we have our Capital Markets Day, where we presented our business development to analysts and investors. And actually, I would like to start today by highlighting three of our key messages that we delivered to our analysts and investors. As you rightly said, the current macro environment is for sure an unprecedented test for organization and for us as leaders. Yet, in 2022, we have delivered 2 quarters of very solid performance already. Second, in view of the current turmoil we are confronted with, we are convinced that business models have to be able to quickly adapt to this new reality, because this is here to stay, and we need to continue to thrive in these difficult circumstances. And in that context, we have deep dive on our business resilience, on our company's resilience. And I have to tell you, we performed really well. We can share more details, so I can share more details as we go through the conversation. And last but not least, our organic outlook for fiscal 2022 is very robust. We want to accelerate sustainable growth for owners, for our shareholders, for our customers, for our employees, and for the society at large, through a combination of organic and inorganic growth in the midterm. So, to address your question, to answer your question, we have been preparing for these turbulent times for a long time. We have anticipated much of what is going on at this time. We have prepared our supply chain to continue to be resilient through regionalizing and further localizing our manufacturing sites. And we are very well prepared, as I mentioned already, to continue to thrive in these unprecedented times.
And is there more to do on that front? Are there external shocks that you still need to prepare for? That's basically on your to-do list.
Look, isn't easy enough having a pandemic that is still here and a war in Europe that is absolutely devastating and is creating tremendous impact not only in our continent but outside globally? Isn't it enough the geopolitical tensions that are heavily influencing our business dynamics everywhere? So that's why I believe that speaking about resilience today and making sure that we look at this holistically is super, super important. And this speaks of many dimensions. First of all, financial resilience. So we are in a very solid liquidity position. We are driving growth and have mobilized our organization for growth. And as I mentioned already, we have delivered a very good, solid first half of the year. Obviously, we cannot forget that the internal engagement of our employees, the well-being of our people, the way we shape the culture is going to be absolutely key to continue to operate with the agility that is necessary in these times.
Okay, I'd like to dig a little deeper on that, on your to expand on the energy costs that have hit Europe particularly hard. And we know the life science division has currently is investing quite substantially in France to make single-use bioreactor equipment. And you mentioned the localization of production that you're looking for. And now we have these huge spike in energy prices in Europe. Does that make you think about the geographic balance in manufacturing, where you have now these big shifts in relative costs on top?
Well, first of all, we are not such an energy-intensive company. right? And above all, our sites are operated outside of Darmstadt. We don't have any major risk to our manufacturing and production operations. In Darmstadt, we have been anticipating the potential shortages of gas, and therefore we have also moved to alternative sources and are already getting the benefit of this anticipation. Obviously, input costs are growing, and for this, we need to make sure that we stay very cost conscious, because inflation, the inflationary environment is creating, significant economic burden to the company, and we have committed to deliver efficient growth and profitable growth. And what we are doing right now is to be able to stay, extremely focused on growth, but also very focused on our cost base. And yet we continue to invest a significant amount of capex to secure our longer term. And in that context, we have invested and announced very recently a significant investment in France, as you mentioned, to expand our capacity for single-use bioreactors. We have invested also on expanding our filtration manufacturing capacity. We are investing heavily in Asia for semiconductors capacity. So let's put it that way, the current situation is not preventing the company to continue to think longer term and to continue to invest for growth, for sustainable growth in the future.
Now, looking at the bigger European picture, the governments here want to become less reliant on suppliers overseas. When it comes to public health and medicines, that has become very apparent during the pandemic. And do you see progress there, or is that push being undermined now by the high energy costs that we experience here in Europe?
You mean investing in research for new medicines due to increasing costs?
Rather the push to become less reliant on supplier, let's say in China, the US, or India. I mean, the themes that we have encountered during the pandemic, where the governments had shown a clear intention, we need to become less dependent, more resilient. I mean, it's a policy question, not so much about your company, but do you think that push that you, I guess, are part of is now being undermined by these high energy costs that everyone's running into now?
Look, if you are speaking about ultimately is globalization being challenged, and are the governments willing to become more local? I think we are always definitely advocating from global trade, and this is something that is being challenged almost every day by unilateral government decisions, and as you can imagine, we are very actively involved in conversation with policymakers to make sure that we can continue to operate with freedom, that we continue to foster globalization to the extent that this is possible, and of course that we help regulators and policymakers understand what could be the implications of their decisions also for the longer term economics, trying to make sure that we have a very solid case to protect, in our case, science and technology, and to continue to deliver for patients and customers, which is what we have done throughout the pandemic and continue to do.
to return quickly on the matter of France. We discussed investments there, but there's also legal proceedings there over a change in the formula of a thyroid drug. And this has been going on for quite a number of years. So a number of legal proceedings. I wonder, what does Merck need to do to settle this matter and bring all these disputes to a close there?
So first of all, we a few years ago we were asked by the French authorities to modify the formula for Euthyrox, which we did, and at the time we conducted everything that was necessary to fulfill the health minister's expectations. Since then, we have commercialized the new formulation of Euthyrox in 40 countries, and more than 18 million patients have been treated very successfully and have been able to address the thyroid balance with our new formulation of Euthyrox. So after, we have several civil proceedings in the past, and most recently there was a hearing in which no judgment has been made, and the court decided to proceed and to continue the investigation. This is not at all related to any safety or efficacy of the new formulation. And we are, once again, absolutely confident of the quality and efficacy of our product, because this has been confirmed by not only the French authorities and regulators, but also European and international authorities.
Okay, thanks. I'd like to turn to your electronics division, a maker of specialty chemicals for the semiconductor industry, where you're one of the largest players, and you're in fact on a multi-year €3 billion investment campaign. So investing quite a lot of money, but right now smartphone sales, which are the biggest driver in the microchip market, are projected to decline this year. So how will this decline play out in the semiconductor market and in the supplier market that you are part of?
Well, so far we don't see any leading indicators that hints to increasing volatility in the semiconductors market. And if you look around, there is a significant shortage of chips, and our customers are building significant capacity to be able to serve the end customers. Obviously, and we communicated this during our Q2 call, we have seen some impact of the softening of the liquid crystals market in Asia, and particularly China. That market is being influenced by consumption, so there is less consumption of devices after the pandemic. We believe that this is a transitory impact, but as I said, not affecting semiconductors, rather liquid crystals, our liquid crystal business, right? Okay. So we don't. I mean, we are very close to our customers, and we don't hear anything that should be questioning the attractiveness of the semiconductors market for the future.
Is it because you're not that dependent on the smartphone or mobile devices market? Are there other applications that are driving this demand, or is it just a question of when that downturn in the smartphone segment will also? I mean, given that it's such a big part of the overall market, is it possible that it's just a question of when this downturn will also be felt in your business?
Chips are used for everything at this time. The end customers have actually expanded very significantly. Think of automotive, appliances, data storage, all kind of connectivity. So we are very, very confident once again that this will continue to be a highly attractive market in which we are extremely well positioned for growth. And this is the reason why we have announced our Level Up program, which is a very significant investment, up to 3 billion in coming years, up to 2025, to continue to serve our customers and the market optimally.
And indeed, we see large chip makers like Intel preparing for multi-billion investments in Europe. Also, Taiwan's TSMC is reported to be looking to invest in Germany. Could these could these also be investment opportunities for Merck, where you maybe make on-site investments as a future supplier for these names that I mentioned?
I mean, you are talking about our current customers as well, and obviously as they expand, we are eager to partner with our customers to help in any possible way. You mentioned the investment in Germany. As you can imagine, we are extremely influential in our home market, and therefore we can help bring agility to the implementation of certain things, and we are eager to partner with our customers to support their capacity building efforts, not only in Germany, but in any country. And of course, this is representing an opportunity for us, no doubt.
Well, these big investments by the semiconductor players typically come with big paychecks from the government, subsidies and such forth, tax breaks. Is that something that that Merck can also then benefit from if it makes considerable investment, or is there only an indirect effect?
I mean, industrial policies are very different across the different countries. So we are very, and I can tell you that the majority of the investment to drive our growth is coming from our own internal resources. And whenever this is possible, and because of the favorable industrial policies that may be emerging in different countries, we will definitely see whether there is specific opportunities in that front. But I can tell you that due to our solid cash situation, the majority of the investment for growth are coming from internal resources. That's a big thing out of in the whole scheme of things.
Thanks. So I'd like to turn to investment opportunities in China. We see this year that the German government is increasingly concerned that the economy, businesses here are becoming too dependent on the Chinese market, and there's this ongoing debate between corporate leaders and the government about how best to respond. I mean, we've mentioned this, you're investing considerable amounts in China and Taiwan. Is this a time for you to reconsider that?
We have a China for China strategy, and this is something that we have implemented over the last 5 to 7 years. I mean, we have been in China for 80 years. We have invested in healthcare manufacturing to deliver medicines that are part of the essential drug list in China. We are investing in electronics. We are investing in life science. As we see, the China pharmaceutical industry and biotech grow. So my view is that we have been very close to the government during these discussions. We need to continue to have a constructive dialogue with those markets which are essential for the German industry and in particular for Merck. And we need to secure a diplomatic conversation to be able to continue to benefit from a win-win situation, while, of course, we need to be aware of the potential risks that may emerge in coming years. So that's basically what we are doing at Merck. We are mindful of the potential risks, and we have built our risk scenarios, but our investment policy has not changed. In that context and strategic frame that I mentioned before, China for China approach.
Okay. Still, of course, it's very clear that there's many people are seeing increasing tensions over Taiwan, and can't help noticing that China is becoming increasingly authoritarian. So when you say your investment approach has not really changed, I wonder, are there any consequences that you're drawing from this development?
We are a global player, so we invest in the US, we invest in Europe, and we invest in Asia, right? And Asia goes beyond China. So one of our most important elements of resilience is our global diversification. We are not dependent on a single continent. Our revenues and also our profits are very well distributed across geographies. We have around, if you look at Q2, we have around 30+% of our revenues coming from China, 29% coming from the US, and a high 30 coming from Europe, the rest coming from other geographies. So we do believe that geographical diversification is giving us resilience, and we will continue to operate in a globally diversified footprint.
I'd like to speak about some.
Have an interruption once again.
So apologies again. We're back with the Reuters Newsmaker interview with Belen Garijo, CEO of Germany's Merck KGaA, and we were talking about the planned potential M&A transactions that you have signaled at your last Capital Markets Day, up to 20 billion euros. And I'd like to know, I mean, you said all your big three businesses would qualify to be strengthened with such a deal. But if I look at healthcare and pharmaceuticals, I see a very specific and very diverse profile. I mean, there is oncology, there's immuno-oncology, there is DNA damage repair, a very specific kind of therapeutic target or technology. How do you think there is that one big target in pharmaceuticals that actually fits that very specific profile that you're looking at, or should we rather expect small deals, like a chain of pearls, as it were?
Let me repeat that our organic outlook is really positioning the company very solidly to deliver on our ambition of 25 by 25. And this is going to be because our big three pillars, process solutions in life science, the healthcare pipeline, and semiconductors, will deliver a significant part of that growth towards 2025. So what I have said is that with that solid organic outlook, we ambition potential acceleration of one or two or the three pillars, right? And I have also spoken about the capacity that we have, 15 to 20 billion. But I can tell you that we are going to be extremely selective on how do we choose our potential inorganic move, and that this is not going to be about spreading ourselves thin, right? But rather looking for what is going to create value for our shareholders and investors. So we value life science because it presents with highly attractive margins and very predictable growth. We value the healthcare pipeline, and there we have been for a number of years, as you know, living on our internal innovation. So we 18 months ago announced an in-licensing deal to continue to build on our strength in head and neck cancer, and we will continue to be on a focused leadership approach, basically looking at strengthening the areas. I mentioned head and neck, but I can also mention colorectal cancer, bladder cancer, in which we have a good positioning, and selectively investing in immunology opportunities, but also semiconductors. So we value life science. We will not neglect the other two products. Our internal pipeline is well placed today. We will have an R&D call in which we will give details on not only on the late stage assets that we have, particularly Xevinapant and evobrutinib, which have emerged as potential first-in-class and best-in-class agents in oncology and in immunology, particularly MS. And we are entering clinic with very promising ADCs. And also we have our DNA damage response franchise that is progressing towards phase 2. So bottom line, this depends on opportunity, right? So I couldn't tell you that despite having a rich potential deal pipeline, well, it takes two to tango, as you may know. And we will definitely continue the scouting to find the best fit for our company in the coming months and years.
Okay, but is it possible that you would opt for a number of smaller deals over the next years rather than going for that one big one?
Look, we have been on a bolt-on acquisition path for the last years, right? Now the environment is once again confronting us with high interest rates, high multiples of some segments, and once again want to identify that good balance between creating value and investing our capital. So we are not fixed on big or string of pearls, right? We will continue to scan the horizon to look for the best possible deal. That's what I can say. And you know, if what we have also repeatedly said is that coming from this bolt-on acquisition phase, we have generated significant liquidity because of our good performance, and now we have the option, right, to perhaps go bolder.
I see. Let me turn to your life science division, one of the largest suppliers of lab equipment, substances used by the biotech industry. And among your customers in the biotech industry, in the pharmaceutical industry, there had been kind of a gold rush, let's say, last year and the years before, extremely high valuations, but that has has changed to a more sober mood, clearly, and I guess lots of these biotech companies have difficulties attracting the investment that they, or the capital that they used to invest. So do you see any of that having an effect on your life science business in the demand for those products?
Look, so far, I mean, we are coming from 2 years in which obviously we have benefited from COVID tailwinds. I think what is encouraging is that our company in 2022, in the first half of 2022, has been able to deliver, as we have said, exactly by our guidance, double-digit growth of our process solution business with a declining COVID business, right? So we are very solidly placed and with a very good positioning across regions, across channels, across customers, that has given us the opportunity to emerge from the COVID phase in a very solid position, because we have a very strong core business that is really satisfying our customer needs. In parallel, we continue to build our service business, right? And we believe that servicing in novel modalities will be one of the growth drivers of our life science business, in particular in process solution, novel modalities, process solutions, for the coming years. So we are very confident that life science is one of our growth engines and a crown jewel as the 2 other big 3.
Great. I'd like to turn to a question from the audience as we're close to wrapping up the interview. The question is, have you seen in your life science business, again, have you seen a built-up of inventory with your end customers? Are they drawing on their inventories now and having an effect on your order book in the near term?
Well, the answer is no inventory building, because for many, many months we had actually seen the opposite, supply tensions. So it is clear that the order book has been fluctuating for a while, but this is more dependent on the ability to supply to demand than anything else. And now, in the face of a better supply and capacity situation, the order book is normalizing. And once again, we are very confident that we are very well placed to deliver on the promises for 2022. We haven't seen inventory building in the end customer, because for many months there wasn't supply to demand.
Very clear. So thanks again for that. So that is, I'm afraid, all we have time for today. So huge thanks again, Belen Garijo, for taking the time today for this Reuters Newsmaker. Thank you very much.
Thank you. Thank you. A pleasure to be